Welcome to Industry Insights. Thank you for joining us today. Today's episode is Top Tax Secrets for the Successful Real Estate Investor. So just to start off, we get 1,000% how valuable your time is. And we can assure you that no matter what role you play in the real estate world right now, this will be time well spent. If you're new to tuning in, we are extra excited to have you experience the educational forum of Industry Insights, and we would love to have you check out previous episodes. These are all available to you in a few different ways for you to access. So you can go watch previous recordings online at civicfs.com/industry insights. And there you will find an entire library of our previous episodes covering a variety of different topics. But you can also subscribe and listen to the podcast found on Apple and Spotify. So just be sure to search Industry Insights with Bill Tessar. So it's now my pleasure to introduce today's special guest, Tony Watson. Tony is an enrolled agent who focuses on providing personalized financial guidance and tax preparation services to both individuals and businesses. So as a federally licensed tax practitioner, he ultimately makes sound financial decisions and works to ensure all eligible deductions are received when preparing his clients' taxes. So when I say enrolled agent, I myself wasn't sure what an enrolled agent was, but the really special and I would say elite thing about being an enrolled agent is that should a client need assistance with audits, collections, or appeals, Tony, as an enrolled agent, is empowered by the U.S. Department of Treasury to represent taxpayers before all administrative levels of the IRS. So in addition to his one-on-one client work, he is also a keynote speaker for Robert Hall and Associates, and he's spoken for hundreds of trade organizations throughout California. His dedication to his clients and expertise has led him to win the Glendale Reader's Choice Award for Best Tax Preparer in 2016. He works with clients in multiple industries, such as entertainment, healthcare, law enforcement, education, the list goes on. But obviously today, the emphasis is going to be on his expertise as specific to real estate. So if you will please give Tony a warm welcome. He is going to be sharing his top tax secrets for the successful real estate investor. And taking the mic with Tony today is our very own Bill Tessar. Bill, as all of you know, Bill is our president and CEO here at Civic. He is our fearless leader. He has over 30 years of mortgage industry experience. He's previously founded and served as president of 3 mortgage companies, bringing a residential funding volume in total to exceed $35 billion. Most recently here at Civic, there are so many accolades and milestones. The list would take me way too long, but some really important highlights that Bill has brought for Civic: funding 10,000 loans, $4 billion in our funding history, and $1 billion in funding in 2020 alone, which is pretty remarkable for the private lending space alone. But then when you add a pandemic to it, that makes it all the more special. He is a Glassdoor top CEO, a Housing Wire Vanguard Award recipient. And like I had mentioned previously, he was the first private lending executive to speak out after COVID-19. And we are honored and really excited that he continues to share his expertise and value add month over month by hosting these forums. Most recently, you may have seen him featured in Bloomberg, Seattle Times, and the Washington Post. So without any further ado, I would love to kick things off by welcoming Civic's president and CEO, Bill Tessar.
Thank you, Gina. Appreciate that. And thank you, Tony, and everyone took the time to tune in today. Here's my truth. I think a close second for all of us in the real estate community in making the money is figuring out a way to keep it. And I think that could impact people from 30 to 55%. And when you think about that dollar and it getting cut in half, it stings a bit. And some of us may have become a little numb to it, like it's just part of the deal. I make $1 and 50 goes away. I've never been one of those people. And there's a reason why some of the wealthiest people in the world pay the lowest amount of percentage in tax. And that reason is not because they're cheating, but they're surrounded by professionals that understand the tax code in the most intricate matters and apply it legally. And so, look, I think it's a real treat today with Tony. He has tax reference as good as any tax person I've met in over 3 decades. And he delivers it in a way that's super easy to digest. Last week, we had a 15-minute meeting scheduled just to go over content. The meeting lasted an hour and we were both getting interrupted to get back on schedule with a busy calendar. And you know what I can tell you is I went into that meeting thinking about how we can make it valuable for all of you. And it ended up becoming very personal because maybe obnoxiously so, but after paying taxes for over 3 decades, I think I understand the tax code as good as anybody. And in that hour, Tony threw some curveballs at me that really put me back on my seat and said, hey, after you're done filing your April, which is now May 17th, tax returns, we're going to get together, because he brought to light some things that I'd never thought about. And so with that, I'm fired up, and I hope you all find at least one nugget out of what Tony's going to share with you today that you could apply to your tax returns. And when you do file them, you'll go, wow, like that meeting meant something to me financially. And so let's get started, if you don't mind, Tony. And I think it starts with, we're talking about real estate professionals. So what is a real estate professional by your definition?
Yeah, great question. Thanks again, Bill. Thanks again, Gina, for bringing me on today. Very, very honored and privileged to be here. Just doing independent research of how long you've been in business and hearing about all of your accolades. It's really, really great to hear that I'm continuing in my own financial world to surround myself with like-minded individuals like yourself and the established company that you've built. Real estate professional status is a very interesting conversation to have with many professionals, not only in the real estate industry already, but individuals wanting to enter into the real estate field. The IRS is very specific about the real estate professional status, and straight out the gate, it seems like an easy election for a lot of people to make. And there are 2 main requirements or 2 main check boxes that you need to mark off for yourself, and also probably guided a little bit by a licensed tax advisor as to why you would be checking these boxes off. 1, you have to actively participate in some sort of real estate business, whether it be being a commission-based realtor or actually owning property that you actively manage. I get this question a lot. There's a lot of people investing outside of California right now. They're buying in Texas and Florida and Memphis. I mean, you name it, people are very interested about, especially bringing the California dollar elsewhere in the US. When you own property outside of California and you hire a management company to manage it, by definition under IRC, Internal Revenue Code, that is not active management, right? So when I say active participation, it has to be either a main source of revenue for you, or 2, you have to actively manage and participate in running that business. So the government's very specific about hours and about active participation. 1, you have to spend over 750 hours working in the real estate related field throughout the year, each year. And then on top of that, 51% or more of your income and time has to be generated through real estate related activities. Those may not seem like very specific elections or specific requirements, and there's only really 2. But when you check that box on a tax return, and there very much is this little box in our software program that you check that tells the government that you are an active real estate professional, by checking that box and making that election, it does significantly increase your risk for questioning on the return, not on all of your deductions, but just specifically on that one election. Because when you check that box, in a good way, you open up a good type of Pandora's box, where it allows you to not see any limitation to the amount of real estate related deductions and specifically losses that you show through real estate related activities. So once again, you have to know why you're checking that box. It's not the Wild West where you just start clicking boxes in a software program to see what increases your refund or decreases liability. So before you actually make that election, this is an absolutely very important conversation to have with your tax advisor, and it deals with active management, active participation in some sort of real estate related activity.
Yeah, Tony, we're going to get into it in a bit, but I think a discipline I've applied early on in my career was assume that every single statement, item deducted, income put on your return is going to get audited and have a defensible position. We'll talk about that in just a second. I have a quick question on the real estate professional. If someone holds a real estate license or an NMLS license, is it an automatic qualifier for being a real estate professional?
Oh, great question, Bill. And I use this example a lot. I know quite a few people in my own personal world, in my own friend list and family list, where they are licensed individuals. They might have gone to law school, passed the bar, and maybe at one point actively participated in some sort of legal advising activity. But if they haven't been practicing for the past 15, 20 years and they've been keeping up with their legal license, does that necessarily mean they're still a professional in the legal world? Well, just because you have a license doesn't mean that you're a professional in that industry. You actually have to actively participate in those industries in order to be seen as a professional. And the IRS will look for the hour log. They'll look for active management or active participation through email logs, through conversations, calls, calendar appointments. So there's very much a story to tell with all of the individual evidence or information to prove that you are actively working within the real estate industry.
Yeah. So, Tone, so many different deductions. And we were laughing together as business promotion and marketing and advertising and auto lease and gas and storage, sometimes business attire. Top 5 deductions on a tax return. What would you say those are?
And Bill, you mentioned something earlier as we were starting off the webinar, that it's not so much about how much you make. It's not so much about how much you spend. It's about how much you get to keep. Now, obviously, how much you make and how much you spend, that's a big part of how you calculate what you're able to keep. But when you talk about tax write-offs, people tend to lock themselves into a specific list of expenses. So don't lock yourself into the list that I'm about to give you, because these are just the top 5 in my opinion, after 17 years of working as a tax professional in the real estate industry and small business industry. People tend to have these specific deductions more than others. But don't think that this is all that you can write off. I want to make sure that everybody, 200, 300 people attending today, don't think that this is the only thing that you can write off on your business return. So number 1, if you want to see exponential growth in your business, you're going to have to promote, you're going to have to advertise, you're going to have to market your business. That is a big part of any industry. And the federal government finds that these top 5 write-offs that we're going to talk about, if you leave one of them off of your return, the reverse effect kind of happens if you don't take certain deductions on your return. It could actually increase your risk for being questioned. Specifically, if you've seen increase in revenue over the past several years or decrease in revenue, the numbers on your return need to tell a story to the IRS. That's the story of your year, your financial story on a tax return. And so if you've seen exponential growth over the past 3, 4, 5 years, the federal government can expect a couple expenses to show up on your return. One, maybe additional payroll, hiring individuals to make business more efficient, to expand your horizon, to bring in more clientele. So that's one way. But then another big part of that growth model is marketing and advertising. And so if you have increased revenue over the years, and specifically actually talking about the pandemic really quick, if you had decrease of revenue from 2020 to 2021, I've seen actually so far this year that a lot of my realtor clients have pumped a lot more money into marketing over the past year than in years past. They've seen unique opportunities to really get their name out, take advantage of a little bit of the downtime, a little bit of the down economy, rebuilding websites, hiring marketing and PR firms. So marketing and promotional absolutely happens to tell the story of either growth and in some very unique cases, maybe even a decline in income coming out of this pandemic. That's number 1. Number 2, professional supplies and equipment. I mean, how many people do you know who can do what they do professionally in today's world without a computer, without a cell phone, without a desk, a chair, a filing cabinet? Those are some of the most common write-offs, and they happen to have the lowest risk for audit. I also love equipment and supplies because we have options of how to write certain expenses off in this particular bucket of expenses. With a computer, let's say that because of the pandemic, I already have less revenue, I already have less profit. And so I'm not paying any tax, let's say this year in 2020, because of me not having that much revenue and still equal expenses as the year before. If I'm already showing no taxable income, why would I force a deduction fully on a return if I didn't have to force it? So a computer actually has options of how to write it off. You can either spread that deduction out over 7 years and depreciate it over the lifespan of the asset, or you can accelerate it by making a Section 179 election. Don't really need to remember that term. That's something that your accountant will know. And you can accelerate that write-off and take it all in 1 year if you need it. But if you're already paying no tax, why would you waste a full deduction all in 1 year? So you have options of how to write it off. One, I like the fact that you have the option. Two, once again, how many people do you know who can do what they do without a computer or a cell phone? So equipment and furniture, so on and so forth. So it also happens to be a deduction that has one of the lowest risks for audit. It is one of the most common things for business owners to utilize in business. So that's number two. Number three, auto and truck. And we'll come back to a conversation about depreciation in a second. So I'm not going to dive too much into detail about the purchasing just yet. But auto and truck tends to be a common conversation with your tax advisor. What should I take? Actual car expenses or mileage? And mileage is written off at about 57.5 cents per business mile. Actual repairs and maintenance costs, a little bit different. Normally, the mileage write-off is going to be a much larger, more consistent write-off. It has a much lower risk for audit because in an audit, you prove mileage with your own notes. You show up with a mileage log. It could be written on a napkin. It could be a smartphone device that you track your mileage with. It could be any way of proof or evidence in an audit, and that's why I tend to like the mileage deduction more. It doesn't mean that actual auto repair and maintenance costs aren't deductible, but we have to determine which one's going to save you more overall in tax. Number four would be legal and professional fees. I don't know a single business owner who hasn't hired somebody for either accounting advice, financial advice, wealth management advice, legal advice. So when you talk about legal and professional fees, that happens to be, also in the bucket of the top 5 overall tax write-offs. Last but not least, and I wanted to mention this towards the end, especially coming out of last year, is the property deduction side of things. This includes in-home office, mortgage interest, property taxes, PMI. We'll dive more into detail of that in a second. In-home offices, a lot of people fear audit on in-home offices. And I want to tell you right now that all of these deductions that we just discussed, they are very much ordinary, necessary, and legitimate in business. And above and beyond, as long as you're being reasonable with these write-offs, I don't care who in the world tells you that it has a higher risk for audit. You should never be fearful of taking a deduction that meets all 3 of those requirements. The government looks for this in every audit. They look for each deduction you take to be ordinary, necessary, and legitimate. And if you check off all of those boxes, above and beyond those 3 check boxes, make sure that you're being reasonable with the allocation of certain deductions. Car, for instance, if it's your only vehicle and you use it for business and personal use, the government's going to expect you to split that write-off into personal use versus business use. Just like with the in-home office deduction, you can't say that 80% of your home is an office space. You can't even, you could say 50%. I have some artists who live downtown in these open workspace lofts. Sometimes they do have a majority of their living space as office space, but it's just not reasonable. And so that may, even if it's true, that may increase your risk for audit. But at the end of the day, all of those boxes check off for that in-home office deduction, ordinary, necessary, and legitimate. So those are my top 5 tax write-offs. Don't use that as your Bible, so to speak. This is just an intro into what you should be maximizing moving forward into, obviously, the 2020 filing season in 2021, and also looking forward into the 2021 tax year for planning purposes.
Yeah, 2 quick notes, and then I have a question about 1031s. For home office deduction, a typical and normal 25%-ish, 25 to a third.
Yeah, so you're going to see, based on industry, different ratios, but yes, tends to be anywhere between 15 and 25%. Here in LA, people tend to have larger spaces. Sometimes they use a portion of their garage. Sometimes they have a building in the back part of their home. You see it a lot more often in California returns, especially Southern California, where people have larger in-home office spaces, especially if they're running online businesses. We're a big tech state. And so when you have these in-home offices, normally it can be the space inside of your home, including the closest bathroom. And then if you have inventory stored in parts of your garage or in units out back in your backyard, you can tend to be a little bit more flexible with the square footage.
Just a statement before 1031s. I talked to a whole bunch of coworkers in the past and business associates, and there is an enthusiasm about not having or saving money with their tax preparer. What do you pay for your tax? Oh, I only paid $300. I only paid $500. I think there is a get what you pay for. It would be the one area I would personally recommend all of you reconsider And it's okay to bite off a little bit more of that bill if you're getting back what you're paying for. We ended up taking a portion of our conversation. I don't think you can overpay if you get the insight that's actually saving you 30 to 50 cents on the dollar. There is that de minimis return. And many times when those go outside the $300 to $500 standard preparer fees to go get some real tax advice, you walk out of there going, why did I not do this years before? So I would encourage everyone to get a second look by an experienced person like Tony before you just do your auto file and pay your tax bill. 1031s, Tone, what is it? When do you use it? Time constraints, qualifiers, disqualifiers?
So there are a list that I consider to be some of the top benefits built into the current Internal Revenue Code. And just to kind of get the conversation started, and we're gonna cycle back to this. A lot of speculation about what is going to happen with the 1031 exchange industry over the next year under the new administration. There's a lot of fear, a lot of concern over this. We'll discuss that more in a bit. I consider 1031 exchanges to be top 5 benefits. In fact, probably top 3 benefits built into the current Internal Revenue Code. Number 1, in my opinion, is the stepped up basis upon death. So the inheritance benefit up to the estate exemption of roughly 12 million bucks. Number 2, a close second, is the 1031 tax deferred exchange. And there are very specific rules that you have to follow in order to qualify for an exchange. 1, it has to be investment property. In the year of exchange, it has to be shown as a rental investment on your return. It cannot be a property flip. It cannot be a primary residence in the year of sale. I'm not saying that a property flip or a primary residence can't be exchanged, but in order for it to qualify for the exchange, you have to convert those properties into long-term depreciable rental investments. And the whole point of an exchange is to take this long-term appreciating asset that you've owned for 20, 30, 40 years, however long you've owned it, and instead of paying the capital gain upon sale, you take that gain, you wrap it up into what's called a trust account. So when the property sells, the money doesn't go to you directly, it goes into a trust account or a holding account. And then within 180 days, you cycle that money back into another property of equal or greater value in order to avoid overall capital gain. There's a couple other stipulations that need to be met, but I think that people get the gist of it. You want to defer the gain and not pay income tax on it. And I call it kicking the can down the road until you essentially kick the can. And at that point, you get the stepped up basis, tax-free benefit, or the beneficiaries of your estate do up to whatever the estate exemption is at that moment in time. But the whole benefit of the exchange is not only to defer tax on the capital gain, but what a lot of clients don't realize, what a lot of taxpayers don't realize, is that when you own an investment property, the federal government allows you to collect rent, to have expenses, but then on top of that, there's a unique deduction. I call it a phantom write-off. It's a common phrase in the accounting world. It's called a phantom write-off, meaning that you get a write-off for something that you're not actually paying for. You're not actually paying dollar out of pocket to get this write-off, and it's known as depreciation on the building. Now, in 17 years that I've worked as a tax advisor, I've run into this conversation, and it concerns me because it makes me feel like other preparers just are giving their clients incorrect advice. The Internal Revenue Code states very specifically that when you turn a property into a rental investment, it must be depreciated, meaning that you don't have an option once you start renting out a property. When depreciation is allowable, it must be taken. And so clients have come to me and they said, hey, listen, my preparer 20 years ago never started depreciation on my rental investment because he said that at the end of its life, I just have to recapture it and pay tax on it. Well, yes, that part is true, but the Internal Revenue Code is very specific about depreciation. Almost verbatim, it says, when depreciation is allowable, it must be taken. And depreciation is when you take the value of the building and you spread it out over the lifespan of the asset, which residential is 27.5 years, commercial is 39 years. So you're not talking about, in your mind, you're thinking, well, if I take a deduction over 27.5 years or 39 years, it's not that much of a write-off. Well, think about this. The building could be worth $1 million, could be worth $10 million, could be worth $100 million. So when you take these larger dollar amount values for buildings over 27.5 or over 39 years, it tends to be a large write-off. And it's not something you're actually physically coming out of pocket for and paying each year. It's the value of the building that you're able to write off over that lifespan. In theory, it sounds great. And I always believe that depreciation is a great write-off because at the end of the day, you can always do an exchange and avoid paying any sort of income tax on that depreciation and the capital gain. But a lot of clients think, well, depreciation, if I'm just gonna have to pay tax on it, maybe I shouldn't take it. And that is not the approach that you should be taking, because that's not even an option. The government says that as soon as you rent out that property, you have to start depreciation. And one of the main benefits of a 1031 exchange is not, I mean, preferring the capital gain is great, but remember, long-term capital gain is a flat tax of 15% in most cases and 9.3% in California. In other states like Nevada and Texas and Florida, there might not be any state income tax, right? So the capital gain is not really the concern in most cases for a lot of people. They know that they're going to have to pay whatever the capital gain tax is, but that nail in the coffin that really pushes somebody to do a 1031 exchange and not outright sale is the recaptured depreciation. And so within 45 days of selling that property, you have to identify new property. It could be one property for 10 properties. It could be one property for one property, 5 properties for 3 properties. However you want to mix and match it, you have 45 days to identify new property in order to fulfill that exchange. Then you have 180 days to actually complete the exchange. If you go one day past 180 days, the exchange fails, it falls through, and you pay the capital gain tax and the depreciation recapture tax. There are very unique ways to kind of at the tail end, at the 23rd hour, if you don't have properties to identify, or let's say that the person who you are in escrow with, let's say escrow falls out and you don't have that exchange property, you can actually bring in more capital, which Bill will talk a little bit about that, or you can funnel the money into a Delaware statutory trust. There are options that you have if for some reason something falls through at the 23rd hour. The goal, though, is to always fulfill the exchange, because what does that mean? It means that you're not paying capital gain tax, you're not paying depreciation recapture tax. And at that point, you're saving possibly 30, 40, sometimes upwards of 45, 50% of tax on all of that. So just understand that there's very much a unique benefit to making sure that you close that exchange, and you need a tax advisor, and you also need an exchange specialist assisting you with all of that.
Yeah, I would say, Tony, some of the most successful real estate investors I know have built a mountain of wealth under 1031 rules and benefits. So look, the scariest thing for anybody on this call or outside of this call to be involved with is an IRS audit. I am telling all of you that because I've been through 3 of them. And if I wasn't as prepared and buttoned up as I am, it could have been a lot more emotional experience. One of the audits went as long as a year. So I got a little bit of reference when I'm talking to you all about what that is. And it doesn't matter how much of an expert you are, how much documentation you have, how buttoned up you are. It's still a very unnerving experience to go through. So I ask you this, what do you think the most audited deduction on any 1040 return or 1120 is in your experience?
So coming into the pandemic, it was no surprise. Even a non-tax professional would know that the in-home office tends to be the #1 most audited deduction on a return. A lot of the general public doesn't understand that there are 2 ways to write off an in-home office. There's actually a full-blown form called Form 8829 that is actually stating the portion of your home, the square footage of your home that is for in-home office use. And that is for the sole proprietor, right? So the individual who is not incorporated, who doesn't have a separate entity for their business. This is for somebody who's working 100% under their primary social security number with no entity structure in place. That in-home office form had, prior to the pandemic, it had close to a 75% chance of audit. It was one of the highest audited forms on an individual return. The highest audited election, which we've already talked about, is the real estate professional election. So you see 2 very unique deductions on an individual return. But I want to mention before I go any further that even though you know that it has a higher risk for audit, there's very, very much still a built-in part of the Internal Revenue Code that states that you are allowed to write off a portion of your home as an office space. And so just because people are fearful of it having an increased risk for audit does not mean that you should avoid that deduction altogether. This is a legitimate write-off for you as a business owner. And so that in-home office deduction prior to the pandemic had a very high risk for audit. I'm going to give you my personal and my professional opinion really quickly, because we have no case study on any of this coming out of the pandemic. This is all so new. This is a new frontier, because in my lifetime, in most of our lifetimes, we've never lived through a pandemic before. We've lived through recessions before and economic turmoil, but at the end of the day, nobody's really lived through a pandemic. If you're 100 years old, yeah, maybe. But coming out of this pandemic, yes, I do believe that there will be an adjustment to the risk for audit on an in-home office, because people were forced to work from home. But make no mistake, it's not the deduction itself that gets people audited for the in-home office. It is the unreasonable allocation of space inside of their home that they use for office space. So that has always been the trigger for the audit on the 8829 form. I still continue to think that that will be a high audit risk item. I think the government, one, is very understaffed. They will continue to be very understaffed until either everybody gets fully vaccinated or until we jump through, out of these colored tiers and start to fully reopen and get back to some sort of normality. But once again, I professionally think that yes, we will see a lower risk for audit. It will still continue to be top tier audit item on an individual return. That is if you're a sole proprietor. If you are incorporated, a different story. Incorporated entities actually don't file 8829 forms. Incorporated entities can actually pay their owners, pay their shareholders rent to rent out space inside of the shareholder's home. And at that point, you don't have an in-home office anymore, do you? Individually speaking, you'd have a rental property on your individual return that receives rent from your corporation. And then you get to deduct the normal property expenses of mortgage interest, property taxes, depreciation, portion of the utilities, portion of the office improvements, so on and so forth. So the game changes depending on how you are structured as a self-employed individual.
Yeah, the thing I would add before we get to our next question is I think it's important for anybody that doesn't use QuickBooks. If you don't use QuickBooks, use Excel well. And what helped me through those audits was I had a date, I had an item, I had an amount, I had a classification of the bill or the expense, and then I had a brief sentence as to what it was as it relates to my business. And what I found was that connected to bank statements and whatnot told the story, and it wasn't just throwing a dart at a board and hoping that it passed. And I think the other thing Tony and I talked about is the absolute no-no as you think about taxes. You can't keep something that you've made off your return. You 100% need to identify every dollar that's come into your business and report that, because that's criminal. That's not a fine or a penalty and an adjustment on your return. It's, orange jumpsuit, state, federal, whatever, right? So you don't want to do that. Agreed?
Underreporting income, absolutely. Bill, thank you for mentioning that. Underreporting income is the one thing, people always fear the IRS from like a jail perspective. People always say, hey, if I take this as a write-off, I'm not going to jail, right? And I always laugh because the deductions really aren't the things that get people in trouble, that kind of trouble at least. Sure, a deduction might be questioned in an audit, but you taking a greater percentage of your home as an office is not going to put you in jail. It's underreporting income, literally taking in money and not reporting it. That is the one thing that really ends up pushing that taxpayer into a different division at the IRS. That is straight up tax evasion. So avoid that like the plague. Proper tax avoidance is legal. Tax evasion is not. So let's properly avoid paying tax, not evading paying tax.
Good point, Tom. So big discussion items with COVID is in-state, out-of-state. And what I can tell you at Civic, we have just over 300 employees. And in 37 years of lending, I have never seen a shuffling of the deck with our employees rethinking about where they want to be housed and raise a family or live their life like I have today. And I think you got Alaska and Florida and Nevada, I think South Dakota, Texas, Washington, Wyoming, New Hampshire, Tennessee, all no state taxes. So just think about this for a second. If in California it's 13 or 14%, for every 100 grand you make, it's 13 to 14,000 that stays in your family. And some people go, wow, if I make 200, that's 28 grand pays for my housing. I'm living free by relocating. And with Zoom and Teams, you still stay connected. And everyone in the world has shown to be productive during these times working from home. So that leads us to like in-state, out-of-state benefits, requirements. Like, give me kind of a brief overview. A few other things I want to cover before we go to Q&A about that. It's a biggie.
And I don't want to go down a rabbit hole because I could talk probably 4 hours straight about California's tax code and how we are the highest tax state in the U.S. and how that is an issue just in itself. But I'll try to shorten it up in summary. California, make no mistake, highest tax rate in the U.S. We have upwards of close to 13% at the state level. And that doesn't even include your property taxes, your sales tax, your city tax, your use tax. So, I mean, you're talking about a lot of revenue made by the state of California on all the hard-earned income that you've built through your business throughout the year. California is one of 8 states, actually, I think probably one of 10 states now, and I can find that list online. It's very easy to find it. One of about 10 states that taxes its residents on their worldwide income. So remember, and when I say worldwide, I mean not just here in the US, worldwide, globally. So if you are residing here in the state of California, like Bill had mentioned, you might be making 100, 200, 300,000 plus dollars in taxable revenue, and California gets a piece of that. Whether you make the money here or elsewhere in the US, if you reside in the state of California, California gets a piece of the pie. Now, sure, there's an allocation and a credit. If you pay tax elsewhere in the US, you get a credit on your California return. So there's no double taxation on the state side. But if you pay tax in a state where the tax rate is 2% and California's tax rate is 4.5%, there is a difference to make up with the state of California. Same with the exchange real quick. You could have a property in Burbank, California for 15 years and never pay income tax on it. And then you do an exchange out of California into a property in Texas, let's say, you own it for another 10 years. And in your mind, you're thinking, well, now that it's a property in Texas that has no state income tax, I'll just sell it and not pay state. I'll pay the federal capital gain depreciation tax, but at least I'm not paying the state. Wrong. California has a clawback clause that says that over the 10, 15 years that you owned it in Burbank and deferred the tax and avoided paying state income tax on that money, California says, okay, now that you've sold the property, we're going to claw back that 10 to 15 years of capital gain and depreciation recapture, and you're going to pay that tax to the state of California. It's called the clawback clause. And that's why when you exchange out of California, you file a federal exchange form, you file a California exchange form, and they follow that investment for the rest of its life. Now, when you pass away, your children get the stepped up basis up to the estate exemption or estate value of 12 plus million bucks. So that's in place. And so you don't individually pay tax if you leave it for your heirs in death, and they get the stepped up basis. But understand that if you ever sell those investments in your lifetime, you got to pay California what they assume that they're due, right? So California, once again, a very, very unique state. We're the highest tax state in the US. When you incorporate here, you have the highest filing fees in the United States. That's why you're seeing this, what I call mass exodus. Over the past year or two, actually 2 years, I've seen more people leave, more of my clients leave the state of California because of financial reasons or job relocation, more in the past 2 years than in the 17 years that I've actually worked at Robert Hall and Associates. So we are seeing a mass shift. People are leaving California. And I don't know if it's 100% for financial purposes, but I do see the benefit of financially leaving California. I don't ever plan on leaving California. And if I do, it'll be for retirement reasons. But at the end of the day, yes, you could very much save hundreds and hundreds of thousands of dollars, especially if you plan ahead on retiring in different states, like Florida, Texas, and all the states that we mentioned.
Tom, one quick question off of that question, then I got 2 more I want to ask before we go to Q&A. How many days a year do you need to live in that state that may have lower or no state tax to qualify under that code?
It tends to be 151 days, but California is also, so when you do the allocation of part year resident or non-resident, it is pretty simple, 151 days. But if you have revenue sourced to different states, which we see here a lot in Southern California with the entertainment industry, where people will film commercials in Georgia for 8 months out of the year, but their residence, their primary state is California, where they register to vote, and they have California license plates and driver's license. So there is a difference of allocation. So that 151 day, that is one of the qualifications, but it doesn't necessarily mean that you're going to avoid or continue to pay California income tax. It's a very unique calculation, and it tends to fall around the 151 day rule. So essentially more than half of the year.
I'm going to cram 2 questions in 5 minutes, so just be mindful of that. Cars, you talked about it a little bit earlier, lease versus buy. What's your thoughts on that?
A great question. Purchasing is going to give you a much larger upfront write-off. If the vehicle weighs over 6,000 pounds, it will qualify for the 100% bonus depreciation. Tahoes, the Escalades, the Ford F-150s, well over 6,000 pounds, even the Tesla Model X with the extended range battery. That potentially could be 100% tax deductible, meaning that if you put $10,000 down, you finance the rest, it's a $100,000 vehicle. It potentially could be a $100,000 write-off for yourself.
Stop there. So just so everyone's clear, if you had $150,000 worth of taxable income, you went and bought a Tesla, you had to write a check for 10 grand. The particular Tesla he talked about, I don't use XS, whatever, it was over 6,000 pounds. Range Rover Sports, over 6,000 pounds. $100,000 car, you take the whole $100,000 that year, reducing your taxable income to 50 grand, And if you're in a 40, 50% tax bracket, it's a $40,000 to $50,000 cash benefit from a $10,000 cash investment. I mean, just like digest that. There's going to be, we just increased car sales in state of California between this 45-minute discussion, Tony, because of that.
I always tell the Tesla guys at the Americana here in Glendale that I should be getting paid commission for how many cars I've sold for them.
It's big though. I mean, that is big. Hey, Tone, real quick, changes in, everyone changing administration. The new administration has been very clear about upping taxes. You and I talked a little bit about this before. You don't really see any changes in the tax code for 2021. Any insight to what you're thinking about for 2022?
So, we're in March right now. So, right, 2021, I doubt we're going to see a lot of the major changes under Biden's administration. But for 2022, I think we all have heard on the news and through what we've read and kind of assumed about this new administration is that they really want to focus on high income earners and tax people. We've been hearing 400,000 being thrown around a lot. And in most cases, that 400,000 is not your gross income. If you're a real estate professional, you're making 400K in gross commission. That's not the person who Biden's administration is really going after. They don't want to tax that person at a higher rate. Because you're self-employed, 400,000 comes in, you'll have your write-off, so you'll be well below, taxable income will be well below 400,000. It's actually when your taxable income, after everything's written off, after your mortgage, interest, property taxes, all of those deductions, if you are sitting at $400,000 or above, after all of those write-offs, yes, in that income range, we could be seeing some significant tax changes in 2022 when the Biden tax bill or tax reform rolls out. Nothing has been set in stone. A lot of speculation right now. So just don't make any serious financial moves or financial decisions based on speculation, based on what your neighbor is talking about, your family members, your coworkers. Ignore all of that. Listen to your tax advisor. That's the most important thing that you could do for yourself. Do not make rash decisions based on speculation. That's probably the best advice.
So you're saying like you walk in and you go 399.9, get me to 399.9 legally, right? Under 4.
Yep, in theory, and what we're trying to understand better from this new administration is if they're going to be phasing things in or phasing things out. Just like exchange, I don't think they're going to get rid of it. I think they're going to phase it in for people or phase it out for some people. So the government loves doing that. They love allowing people to benefit up to a certain dollar amount. And then as you breach that threshold and enter into the new bracket, they phase you out from being allowed that benefit. I truly think that there's going to be a lot of phase outs under the tax reform bill as soon as it is introduced.
So Gina, here's what I'd like to do, if you don't mind. I'd like to go to Q&A because I think we're going to have a few. And then Tony, I want you to think about this question as you're answering other questions, is when we say goodbye, I just want you to give everyone maybe 3 small bits of advice as takeaways that they could tuck away and bring to their tax preparer or to you. So go ahead, Gina, Q&A.
I will say we have several questions. So with the amount of time left, I know we're not going to get to all of them, but we are going to do our very, very best. With that said, I'm going to start off by saying, if you are interested in setting up a private consultation with Tony and his team, I'm going to give you his email address that you can contact him at, because I know we're not going to have time to get to all of these. So his email address is Tony Watson, TonyWatson at roberthalltaxes.com. And to jump right into it, one of our first questions is from Vincent. If the proposed Biden tax increases on individuals and corps gets passed, what do you see as the impact on real estate investors? And how should investors using LLCs prepare for increased costs?
Great question. So I am a firm believer as not only a tax advisor, a public speaker, but also an active real estate investor myself. I own properties in Texas. I've owned properties in the past in Florida. My family owns properties. So I practice very much what I preach. The real estate professional will continue to be, in fact, just talking about self-employed individuals across the board, will always continue to be the individuals, the taxpayers who can retain the most benefit out of the Internal Revenue Code. I don't care who's president, nobody's going to get rid of business write-offs. When you're self-employed or when you have a rental property or a property rehabbing business, on those forms on an individual tax return, we will always see a dollar for dollar benefit for a majority of your expenses because it's earned self-employed income or non-passive rental income. W-2 wage earners haven't been allowed a lot of deductions since 2018. In fact, they've always technically been limited, at least for the past 17 years that I've worked in the tax industry. So the W-2 wage earners really get hit the worst. The teachers, the firefighters, the police officers, the accountants, the mortgage lenders who work for a big mortgage firm, the real estate investors, the rental income collectors, and the self-employed commission earners, or even online sales businesses, so on and so forth. They will continue to be able to maximize their write-offs under their businesses. Now, you mentioned about the LLC really quick. I want to mention this straight out the gate, and I don't want to dive into too much of the power of Inc. topic, but LLCs provide absolutely no tax benefit. I want to make sure that everybody understands that. LLCs can make a special election with the IRS to be taxed as a different type of entity that might offer some tax benefit. But if you are just holding an LLC for title of a rental property, LLCs provide absolutely no tax benefit, income tax benefit. All they provide is limited liability protection. So Biden's administration has not talked about changing the tax rate for S corps or for LLCs. And here's why. Those two types of entities in the tax industry, we call them pass-through entities, meaning that they don't actually pay federal tax at the company level. They actually pass through the income and the profit to the individual on the personal 1040 tax return, and we individually settle up with Uncle Sam in whatever state we're filing in. On the C corp level, different story. Under the Trump administration, they had dropped the tax rate significantly to 21% from 35%. Biden is talking about repealing that. Once again, it's all speculation, nothing set in stone, but they're talking about jumping that back up to 35%, the larger corporations of the world. Under the old tax bill, actually, if you were able to get your net profit below 50 grand as a C corporation, you were not subject to 35%, you were subject to 15%. So a lot of these ins and outs of corporate entity structures aren't really discussed a lot because there aren't very many preparers out there. Well, I'm not being very general. All preparers should be knowledgeable in corporate taxation, but I find that a lot of preparers who have been practicing a very long time, and the code has changed a lot over the past 20 years, especially coming out of the dot-com boom, and they don't understand how to operate corporations in efficient ways. The only entity out of all three entities that you have to choose from, the C Corp, the S Corp, and the LLC, the only entity that will actually save you tax is the S Corporation. And I absolutely suggest, because I don't want to spend too much time on this, for you to have a conversation with either myself or one of my senior advisors here, Robert Hall, about what entity would be specifically and uniquely right for you. Incorporating is not right for everyone. I want to make sure that I say that as well. Incorporating is not going to be right for all of you, but some of you today may be able to maximize the benefit through the S Corporation and significantly save yourself thousands, if not hundreds of thousands of dollars in tax by doing so.
Thank you, Tony. Okay, so with mortgage insurance deduction being maxed at $750K, I heard you can add $100K equity line. Is that true or not?
So yes and no, because some people, like I said earlier, the IRS loves to phase people in and phase people out of this benefit. And so I just want to mention that whether you're married filing joint, single, head of household, or married filing separate, you can include up to $100,000 in equity line of credit debt, but you're not allowed the $100,000 as a write-off. You're allowed the interest on up to 100 grand, but only if your adjusted gross income, not your taxable income, but your AGI is below $109,000. Okay. And I believe that the federal government is planning on extending this through future years. I don't foresee Biden's administration changing anything about this. So yes, equity line of credit interest is still tax deductible, and mortgage insurance is still tax deductible, but it does phase in. I'm sorry, mortgage interest. Let me peel back. Mortgage insurance is limited to AGI of 109,000. The actual equity line of credit interest is only deducted up to 100,000, but there is no phase out for that. I apologize. I was talking about mortgage insurance for a second there. Mortgage interest on a primary residence debt is only allowable up to $750,000 of debt now as of 2018. But if you bought the home prior to December 15th of 2017, you're actually grandfathered into the old tax bill, which still had a limit, but it was on $1 million of first position debt, not $750,000. And remember, this is for a primary and for a second home. On a rental investment, ignore the limits. If you rent out a property, there is no limit on your mortgage interest write-off. There is no limit on your property tax write-off. So it all comes down to the conversation of, hey, well, what is this property actually used for? Is it an Airbnb VRBO? Is it a 12-month, 24-month lease property? Is it commercial with a living space in it? I mean, there are a lot of different unique parts of a property that could limit or could fully allow the interest deduction on the primary, on the first position loan. the equity line of credit, and then also mortgage insurance premiums, depending on the nature of the property.
Yeah, just not to beat a dead horse with a stick, but for everyone on this call, if you haven't figured it out yet, like it is worth going to a higher level tax preparer such as Tony to have him take a look at your returns and see what the opportunities are. It pales in comparison to whatever few $100s you think you're saving from, you know, the quick and easy send it off. There's just so much to know in the tax code, way more than any of us can figure out. And it's really one of the things I appreciated so much about your group, Tony, in that you do have different fractions that focus on different parts of the code. So collectively, you all bring it to the boardroom, and you know how to apply it to your different clients. It's just, I couldn't overemphasize enough. Tony or not, Tony or someone equal to his caliber, every one of you should be thinking about how to have your return reviewed, because you're talking about substantial dollars that are going to remain in your bank account. Gina, do you have any other questions that you want to cover before Tony takes us away with 3 send-offs?
You know what? One was just a quick clarification when we were talking about real estate professional, clarifying if the box that is to be checked is called real estate professional. Was that correct, Tony?
So I can't speak to the TurboTax software, and I can't speak to other software programs that you may be using, but I do have to mention that the software that we use is called Lacert. And so I've used that for 17 years. There is actually a box on a Schedule E and a Schedule C form on our tax return that you check real estate professional. And I believe that actually is an election through all of the other software programs as well, because it's known as the real estate professional election. When you check that box, you remove all limitations to real estate professional losses. I'm sorry, to rental property losses and other like-kind related deductions, meaning that there is no limit to what you can write off if you are a real estate professional pertaining to real estate related activities. It is the unicorn of the election part of the tax code. And that is why it tends to have a higher risk for audit, because it removes all of these incredibly significant limitations. And just as a side note, once again, I don't want to waste time here, but this code, the real estate professional side of things, most of that code has been around since the early 60s. So when we talk about, Bill had mentioned very early in the conversation that the wealthy of the world, they tend to build wealth mostly through real estate. And so individuals who have built exponential wealth over the past 60, 70 years, it's because of a part of the Internal Revenue Code that's been around since 1962, I believe, that has allowed real estate professionals to check that box and make the election to where they are not seeing any limits on what loss deductions or tax shelter benefits they receive through real estate related activities.
Tony.
Perfect. And one quick question, Bill, is do you prepare taxes for California specifically or other states as well?
So like we mentioned earlier, the enrolled agent status, we hold a federal license, so we can prepare taxes in all 50 states. Whereas a CPA normally will hang their license in one state, maybe multiple states, but they tend to focus on accounting, not so much tax preparation. And so in a lot of cases, people think, well, I need a CPA because they're going to do everything for me. And if that's the case, you're looking for a CPA to do your books, your payroll, your cut checks for you, pay credit card bills. They're going to be a CFO for your business. And that's why a CPA firm probably has a much lower number of clientele that they service, but they do a lot for that client. Not everybody needs a full-time bookkeeper. Not everybody needs payroll. Not everybody needs audited P&Ls. Most people, I'd say that 98% plus of business owners, they need a good tax professional. And that is what an enrolled agent is. We are income tax professionals. That is what we focus on. And so when we plan ahead, we are planning essentially to use the code to pay less income tax. And so most people, they end up only needing an income tax professional, but not all of those other services that you could end up paying for if you go to see a CPA.
Tone, 3 bits of advice so everyone can walk away and apply it to their own personal positions.
Number one, surround yourself with like-minded people. I cannot stress that enough. Over the past, I bought my first property when I was 21. My family has been in real estate. Also, both my parents were teachers. So I grew up in a household where education was key. Number 2, it was to invest money in real estate. And then I always saw my father surrounded by like-minded individuals, other real estate professionals, other business owners. And I always saw him handling tax issues and going and collecting rent and signing agreements and contracts. So that is the household that I grew up in. So And I very much have learned over the past 17 years that it is very important just to surround yourself with great advisors, lenders, financial planners, wealth managers, tax professionals. And like Bill had mentioned, there may be a difference in fee, but in this industry, in the tax industry, in the wealth management industry, in the lending industry, you pay maybe a little bit of a premium, but you get a lot more benefit out of that. And at the end of the day, most of those expenses are going to be a dollar for dollar write-off for a lot of self-employed investors. So keep that in mind. Surround yourself with like-minded individuals. Number two, whatever profit you make, double down on that profit. Don't overspend. Think wisely with that money. And the goal here is, once you have a cash flowing property on paper, and this always is a conversation with a tax advisor, take that cash flow, buy more real estate. My business 101 course teacher in college, he said it perfectly. He said there are 3 rules in business. Number 1, pay your employees. And I agree with that. Pay your employees because they do a lot for you, right? They help you be more efficient and build business. Number 2, he said, reinvest profit back into infrastructure. Take your cash flow, buy more real estate. Take your profit from your business, buy new equipment, hire individuals, take advantage of programs that the government has out there for you, and build your business that way. And number 3, which stuck with me over the past 17 years of my career, number 3, he said, is pay as little tax as possible by exercising rule number 2. And that makes a whole lot of sense to me now as a tax professional, because the government will allow you a dollar for dollar reduction for ordinary, necessary, and legitimate business expenses, and will allow you to pay less tax by reinvesting into yourself and into your business and into your property. So always remember that. And number 3, last but not least, I mentioned this earlier, it's not about how much you make, it's not about how much you spend, it's about how much you get to keep. And I want you all to switch, to flip a switch to where you think of tax planning and tax preparation, not as a painful thing, right? Nobody likes income tax. I like it because I get paid to do it, right? I do it as a career and I enjoy helping people. But at the end of the day, think of it not as a painful thing, not like going to the dentist, right? Think of it as helping you retain wealth. I tell my clients this all the time. If you come to me or if you come to our firm and we save you $10,000 in tax by moving things and shifting things around, were you not just able to retain $10,000 more of your wealth that you built over the past 365 days? It's keeping money in your pocket. And once again, it's not about how much you make, it's not about how much you spend, it's about how much of all of that money you get to keep. So wealth retention is equal to tax savings. And that is the approach that you need to always take as you get ready to file that final exam with Uncle Sam at the end of each year, known as your tax returns. So keep all of that in mind. And once again, Bill, Gina, thank you so much for having me on today.
Thank you, Tony.